The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. We have a lot to take a look at here after Tuesday's trading session. A rough day in the soy complex, especially in beans. Kansas City wheat, one of the downside leaders. Corn able to sneak out a few green numbers on the screen, though. We saw more pressure in livestock. A lot, again, to discuss here today. Joining us now, Brian Splitt with agmarket.net is our guest analyst here today. Brian, thanks for being on the show, and hope things are going well, hopefully better than this market trade after Tuesday's session. Just a pretty rough day led by, as I mentioned, soybeans and Kansas City wheat, Brian.
Yeah, the weakness in the soybeans, when you have such a drastic discount of Brazilian prices to U.S. prices, the flat price weakness shouldn't be a surprise. We do still have tight domestic stocks and very strong crush margins, so that's probably the one bright spot. But something I thought the USDA would do on the WASDE report earlier this month was increase the import side of the balance sheet for soybeans, and I think that's probably still coming down the pipeline. And maybe we get it in the May WASDE report once they start really looking at the new crop balance sheet with our first official estimates. Hard red wheat, gosh, I mean, disappointing trade there after the freeze event that we had over the weekend. I got some text messages on Sunday that it was well below freezing for at least 7 to 8 hours, and not just a degree or two below freezing, but as much as 10 in the areas that I was getting info from producers. So I think the fact that the conditions in Kansas improved slightly really negated any friendly attitude towards that. And so I think it just shows the intent from the fund manager to continue to sell rallies in wheat, regardless of what the rhetoric is. We had no shortage of things that should have been supportive early this week between that and the rhetoric out of Moscow. And here we are, making new lows for this move. So yeah, it was a negative day, and corn was really the only one that was able to fight back and get back to positive on the session late in the day.
Well, thinking about KC wheat first in this whole wheat complex, I'll stick there for a second. I know there's the talk of the forecast 1 to 2 inches in some of those dry areas of the southern plains, but I have to wonder, just with the freeze and just the poor condition of much of that crop, how much is that rain really going to help it? And I think that's maybe an excuse, so to say, for funds to get out of some of their long positions here in wheat, especially in KC wheat, Brian.
Yeah, I mean, I think they've been getting out of long positions. One of the other things the funds have had on is long KC versus short Chicago. So we're seeing that spread really correct as the forecast has that rain in there. But you're right. I'm not an agronomist, so I don't know. I don't know what rain at this point will or won't do for the crop, especially in the areas that had that freeze event. But the market just doesn't seem to mind at this point. Now, maybe the positive here, I've got kind of a lower end of the trading range, lower end channel on KC wheat. We got down there this morning. We had traded down below $8, $7.94 on the low. We came back off the lows and finished above $8. So hopefully we ran some of those stops below the big round number and closed back above it. And maybe we could see a little bit of upside mobility after doing that. But the market just continues over and over and fails at the same spot, which is really that 880-ish area on the July hard red wheat. So if we do see another run up to the upper end of the trading range, I think if you're a producer, you have to look at that as an opportunity to get something done, whether it's buying puts or making sales or whatever your risk management methodology would suggest.
Brian, let's dive back into the soy complex a little bit. You mentioned the cheap Brazilian beans, and farmer selling has continued down there. I know we heard the talk. The U.S. bought some Brazilian beans and imported them in. Looking at the export situation, as you look at these charts and hear a lot of this chatter, Brian, I guess my thought to you, or my question to you is, are we looking at some demand destruction here, especially in this soy complex right now? What do you think?
Well, I think the industry as a whole has been talking for months about what they thought would happen with a large Brazilian crop that was delayed because of the drought that we had in Argentina. But it appears that that long-term outlook is coming to fruition maybe a few months later than expected. And so, yes, we're going to have world buyers continue to go to the South American competitor. In the meantime, any business that we get in the short term on old crop soybeans, which doesn't make a whole lot of sense to see that, but I think eventually some of that business may get rolled into new crop, and we may not actually see all of that ship. So that's something else to be mindful of. And I think from the producer standpoint, when you see what is going on in that price difference between Brazil and the United States, and you look at that in the soybean market specifically, I think you have to be mindful that that is exactly what could happen as we get into the latter part of summer for corn. Brazil is going to have a very good safrinha corn crop unless something turns drastically in the short term. So there's going to be that period of time where before we have our new crop harvest, we're going to get tighter and tighter on our old crop pipeline here domestically. Yet you will have a new crop supply available out of Brazil. So I think you're likely to see the same dynamic happen. Maybe this is 3-4 months down the road, but I think it's going to be something that comes to fruition in corn. And the problem is that's going to be leading right up into our own domestic harvest, where we're going to have a new supply of corn here. So I'm quite bearish long term on new crop corn. And boy, if I could just get producers to listen to get hedges on, I think they're going to be happy in 6 months. But it's been a tough road to hoe there.
Yeah, and I was gonna say with corn, I know we got the Chinese cancellation of export sales on Monday. Some folks, I heard some chatter, they're a little concerned about that. Does that worry you at all in this corn market right now, Brian?
So hard to say if that is just a one-off. Maybe it has to do with the sheer premium that May has had over July. Do you see China cancel just to buy it back off the July contract in a couple days? I could see that happening. If that's the case, then we would like to see some confirmation of that and see some purchases of corn by China in that 300, I think it was 327,000 tons. So you'd like to see a purchase in roughly the same amount within the next couple days. And remember when the March contract was down here and the May was the front month at that point. And May still is front month, but we're going to be going into delivery and options have already expired. But just from a sheer flat price perspective, just above $6 is where China came in on their last round of buying. And that first purchase was a pretty big one. It was over 1 million tons, and they strung together a few in a row. So hopefully China sees value at $6 in old crop corn. If you look at where July made some lows this morning at 601, that's exactly where I have the uptrend drawn from the lows made July of 2022 to the lows made in March. So we are at what should be some good short-term support with that trend line there. We did close back near the highs of the day, so we did see some buying. Hopefully we can turn a little bit of a corner here. And really the pattern that I'm expecting is to continue to make highs, roughly mid to late month in May and in June again. So I wouldn't be surprised if we put in a little bit of a low and then see this market bounce again as we get into mid to late May.
We're having a conversation today with Brian Splitt of agmarket.net. Brian, you made a great comment when you're talking about maybe getting some hedges in place there in corn, and wish that producers would listen. Obviously, busy time of year. They're thinking about spring planting, want to get this crop in the ground, but don't want to lose sight of your risk management. And obviously, looking at all of these markets, feels like there's room to the downside here. Corn, beans, wheat. There's all these different factors swirling around. So what would you tell producers when it comes to risk management during a busy time of year like we're in right now, Brian?
Well, it's been one of those things, and I think back over maybe the last 6 to 8 months, and there's been an excuse each time. We were 630, 635 December corn and fall, and it was, well, why am I going to sell this price when I'm delivering $7 corn out of the field? And I get that, but we've seen that movie before. That's what it was in 2012 and 2013, where the spot market had a very good premium over the next year's crop. And the thing is that was your best opportunity to sell next year's crop. And then it was, well, I don't want to sell here because of my input costs are so high. And that to me is the argument why you need to lock some of that in and pay for those input costs. Those input cost decisions were being made at $6 plus corn, and that's where those inputs were bought. Now we're at, sub 550. So now it's, well, I'm busy in the field. And so, bottom line, and we preach this, and you were there in Nashville with us, Jesse, where it's like, you got to look at what your costs are, and you have the ability to lock in a profitable level on your production. And leave your upside open, or allow yourself some upside mobility. And there's plenty of ways to do that. So to just ignore it is, I don't know the right way to put it, but that's just not the right thing to do. You're not in the business of marrying your crop every year. You have to sell it. And I'd rather see that be sold at a profitable level than next fall, in which, in my opinion, we're going to be severely below cost of production if we have a good growing season and we're competing with South American corn in the long run. And I think it could be absolutely devastating to the farm economy if that's the case.
Well, and to your point as well, the excuse might even be right now. I don't know if it is or not, but it's, hey, I'm focused on getting the crop in the ground. But to where we're at now, 2023, there's so many tools available. A phone, everything from a phone call to an email to a text message to their trusted advisor, broker, whatever, to an app, to whatever you're using. There's a lot of different options and strategies, and there's so many tools available to help you manage that risk. It just makes so much sense, Brian.
Yeah, and that's the thing. You're going to be planting during spring. And if things go well, generally as that's happening, the market is taking risk premium out as producers get in the field and get the crop in the ground. And I think that's one of those things where you use an option. Say, hey, for this period of time, I'm just going to set a worst case scenario. We've talked for months about the importance of 540 on December 23 corn. We had made a low there the day after Russia invaded Ukraine. We made lows just above 540 in July of 2022. Those were our summer lows after making the contract highs. We made lows down here again in March, and here we are here again in April. Now, 2013 still looks like a very good roadmap to follow. The things that are similar so far would be in 2013, the high for the calendar year was the very first trading day of the year. That's the case so far for DEES 23. At the beginning of February, when we were setting our crop insurance price, December 2013 corn started around that 590 area, which is right where we started this year. Then you think about the quarterly stock and the planting intentions report. In 2013, DEES corn was making highs just above 570, which is what we did this year. And then what we did is we went right back up in mid-April to late April. We made another high at that 570 level, where DEES corn just came from 571 and a quarter last week. So I still think if we follow that roadmap, you're going to get a couple more shots, one in May and one in June, to sell up against that 570 level. But if you keep seeing it fail there, it may not be the price you want, but that's the price you might have to take. And I would remind viewers that in 2013, the fall lows were being met at about $4.10 a bushel. So now my focus is not only 23, but I think producers need to get these 24 sold If you get 545, 550, I think you have to be aggressive there.
Good things to consider. Let's talk livestock a little bit here, Brian. Cattle and hogs both lower on the day on Tuesday. Have to think maybe a higher dollar weighing in there a bit as well. But I know cattle reacting to Friday's cattle on feed report still possibly. Some folks, said that the numbers were bearish. Some folks have argued to me that the numbers weren't really all as bearish as many people made it out to be. What's your thoughts with this cattle market reacting to last Friday's report and just how we've been looking so far this week?
So I think the cattle market did what it's been doing, which is it took a dip and it was bought. And so now, knowing that the low we made yesterday was kind of that post-report low, and we rallied off of it for that day, I think that places a large amount of importance on yesterday's lows in live cattle. So we had that good one-day recovery bounce. It was a little soft today. I think you start seeing live cattle close below yesterday's lows, and at least as a producer, you say, okay, things are changing a little bit. I can go short, and I don't have to risk a lot for this market to make a new contract high and prove me wrong. And so I'm going to be patient. I'm going to wait and see if we take out yesterday's lows, and if not, then great. But if they do, I think that signals that we have to have some kind of action taken to protect downside values. And when you think about grain reports, I mean, how many times have you seen a report where the market, got a bullish report and we make a high, and then that was the high, and then we go back down. Mm-hmm. So I think it's not the best thing to look at the trade immediately the day after the report or the day after that. You got to kind of look at what develops in the next couple of days following those reports.
Well, and I think that that statement as well can help me kind of weave hogs into this discussion, just the broader livestock trade. I know Friday, Monday, we saw a bit of short covering in hogs, and I was hoping to see a little bit more of that on Tuesday. Really didn't see it. We ended up fairly mixed, but I just think overall, to your point, as some of these markets move and shift in this livestock trade, especially watching a couple of days after and seeing how it trades is pretty important, Brian.
Yeah, and as good as this bounce has felt here short term in the lean hogs, I look at the June contract, and we made a recovery peak in mid-March, and we broke from there, and we had another secondary peak, and that established a little bit of a short-term downtrend. That's where the market failed yesterday. We failed there again this morning on the little bounce. So we have to get some constructive things to happen technically. We have to take out resistance. Just being a couple bucks off the last low doesn't really generate any major technical buying. We have to start taking out some trend lines, closing above some moving averages, closing above some previous peaks. And once you start doing that, then you build a case that, hey, maybe a low has been made. But until that happens, these look like they're just dead cat bounces at this point.
Well, Brian, overall, a lot of things to watch here. I haven't brought up energies or the broader financial sector at all. I know that's kind of a Pandora's box. Anything you're watching closely there?
Yeah, when I think about crude oil and the way that it's traded after the OPEC production cut, so crude oil gapped higher. It basically gapped up, opened at the 200-day moving average, and it held the 200-day moving average for several sessions. And then it kind of popped into some new highs and lasted for a day, and then it rolled over again. And so now we're back below the 200-day. I think we held the 50-day moving average on the lows here this morning. And I still think this high that we made in crude oil after that production cut was simply back up to the upper end of the trading range. The lower end of the trading range is down around 70. And I think we'll probably settle back down in that area. Again, the market got bullish short term on OPEC reducing their production, but they did that for a reason. And I think long term, they're concerned about demand. So those are the two things that I think you have fighting each other currently. So I think crude oil probably, gets its gap filled, fills the gap, and probably goes down a little bit more, back down to the low end of the range. It's hard to think, at least in the short term, we go aggressively below 70, just because apparently this is where we're supposed to fill our reserves back up. But I don't know if we do that. I mean, we were below 70 by several dollars last time we made some lows, and we didn't have anything done. So I'm not sure exactly what the administration is really going to do, but they're all in on the green agenda. I mean, that's painfully obvious. It's the last thing I want to do is be forced to buy an electric vehicle, but it seems like that's what their hopes and dreams are. I don't like it.
I don't like it either, to be fairly honest with you there, Brian. And it's something that we're going to have to continue to watch and see how it plays out. Well, of course, as always, we appreciate your time and analysis. And I know if folks want to reach out to you and the team there at agmarket.net, they could do that very easily. You guys have a lot of technical analysis and a lot of great ways to get in touch. And agmarket.net, I know, is the best place to start, isn't it, Brian?
Yeah, go to agmarket.net. That's the website. You can get a 30-day free trial of our intel, which is our research. There's a bunch of stuff you can sign up for. You can pick and choose what you want and don't want to see. You can call us at 844 for Ag Market, so 844-424-6758. I'm going to leave with just one little bit of positive thing to think about maybe moving forward. And this is maybe a good potential bright spot for corn demand. Sugar prices. Sugar prices have been going up rather aggressively because of production in Brazil. And when we saw that, Brazil will not use sugar for their ethanol needs. And last time we saw that happen, we saw some really aggressive corn for ethanol usage. So I think that could be a good bright spot here in the short term, is what sugar values could potentially mean for corn for ethanol.
I like ending on a positive note. Brian Splitt, agmarket.net. Always a pleasure, sir. Thanks for joining us. Have a great week.
You too, Jesse. Thank you.
That's going to do it for the show today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.